Welcome everyone to Token Topics. I hope you're all doing great. In this special video, we're going to hear from Caitlin Long, the CEO of Custodia Bank. She's a prominent figure in the crypto and blockchain space, and she's been fighting hard to bring in regulatory clarity and mass adoption. If you've been holding crypto for a while, most likely you know who Caitlin Long is, and if you don't, you're going to learn about her in this video. It is a treat to hear her talk on the topics of regulation, mass adoption, and more. She says that there is a coordinated effort to deplatform crypto from the traditional banking system, and there's a civil war going on over the power in Washington. Now, that is not surprising, but let's go ahead and listen to Caitlin Long and get her perspective. Before I begin, I have a special DCENT wallet announcement. I'd like to inform listeners and viewers about the incredible amount of coins and tokens the DCENT wallet can hold. If you're still holding your crypto or digital assets on an exchange, you really should consider holding it on a personal hard or soft wallet. With DCENT, you have 3 different wallets to choose from. My favorite is the hardware Biometric wallet for added security. Now, you might not know this, but DCENT wallet can hold nearly 2,000 different coins and tokens. It's pretty incredible. I want to show you how easy it is to look up a coin or token from their website. So from their official website, up at the top you'll see supported coins. And you can scroll down and see the huge list. Now if you want to look up a particular coin or token, all you do is just go up to the search here. I'm going to give you an example. One of my favorite is Space Chain. Now it is an ERC20, and most ERC20 tokens are going to be listed on the DCENT wallet anyway. But that just gives you an idea how awesome this is. So you can check it out and see if your favorite network is supported by the DCENT wallet, and most likely it is. Now, if you'd like to explore and see if they have your favorite coin or token, I'm going to put the link to the DCENT supported coin list in the description below. Before we listen to Caitlin speak, let's get a better understanding of her background and experience. She's the founder and CEO of Custodia Bank. She's a 22-year Wall Street veteran who has been active in Bitcoin and blockchain since 2012. In 2018 through 2020, she led the charge to make her native state of Wyoming an oasis for blockchain companies. In the U.S., where she helped Wyoming enact 20 blockchain-enabling laws. That is massive. From 2016 to 2018, she jointly spearheaded a blockchain project for delivering market index data to Vanguard as chairman and president of Symbiont, an enterprise blockchain startup. Caitlin ran Morgan Stanley's pension solution business from 2007 to 2016, held senior roles at Credit Suisse, and began her career at Salomon Brothers. She is a graduate of Harvard Law School, the Kennedy School of Government, and the University of Wyoming. Very impressive background. Now, a little background on Custodia Bank. Custodia is a Wyoming bank formed to serve as a compliant bridge to the U.S. dollar payment system and a custodian of digital assets that can meet the strictest level of institutional custody standards. Custodia is required to fully comply with all applicable laws and regulations, including the Bank Secrecy Act and federal Know Your Customer Anti-Money Laundering and related laws and regulations. Custodia will also comply with Wyoming's Special Purpose Depository Institution and Digital Assets Law, which include requirements that fiat deposits be 100% reserved, that the Custodia meet the strictest consumer protections in the digital asset industry.
Hello, I'm Michelle McCory, and this is Kitco News coming to you from the Masari Mainnet Conference here in New York City. And one of the topics very much in focus at this year's conference is the regulatory hostility towards crypto and DeFi. Well, my next guest says that there is a concerted, coordinated political effort to deplatform crypto from the banking system, and that it is being directed by factions from within the White House, and that she is fighting back. Caitlin Long is the CEO of Custodia Bank. Caitlin, great to have you with us.
Thank you. Thanks for having me on. It's great to be on your show. I've watched your work for a long time. It's really an honor to be with you.
Oh, well, it's an honor to talk to you, especially seeing as you're such a trailblazer in this fight against some of the hostility that we're facing. We definitely want to talk about that. Also want to talk to you about the political intersection that you've pointed out between Bitcoin halving cycles and elections. We'll get into that, get to a macro outlook, and of course, something that you don't really do, but we are going to get your outlook on the price of Bitcoin. But before we get there, I want to start off with an overview of Operation Choke Point 2.0. Now, the term originally came from an effort by the Obama administration where they were deplatforming businesses that weren't illegal, but they weren't necessarily fans of, like gun stores, for example, cutting their access to the banking system. And then after the collapse of Signature Bank in March, which had a lot of crypto customers, Nick Carter coined the phrase, I believe, Operation Choke Point 2.0, and was saying that there is a concerted effort to cut the crypto sector off from the traditional banking system. So for our viewers that are not familiar, give us a little bit more of a background on what is happening there.
Yes, you're right. It started during the Obama administration. Federal bank regulators in the United States, specifically the FDIC, moved against a total of 30 different industries. And it was applying pressure through the bank regulatory process to debank certain industries. It started with payday lenders and expanded to 30 different industries before Congress and the Trump administration put an end to it. There were lawsuits, and it was revealed that there were some nefarious things going on. The lawsuits were settled. The FDIC agreed not to pursue it. But to your point, it's back under the Biden administration. And we knew it was real from January 27th, actually January 25th or 26th, one of those days. We got an email from a reporter who had been leaked the information that all of the applications at the Federal Reserve and the OCC, the U.S. federal bank regulator that had anything to do with the digital asset industry, were being asked to be withdrawn at the same time. And so we knew that it was a coordinated effort from the very get-go. We had the receipts, so to speak, because we had it in email. And reporters were telling us behind the scenes back in January what was happening. The leaks were stunning. One of the leaks was that Custodia's application would be voted down by the Federal Reserve Board of Governors before we even decided whether to withdraw our application. So the reporters were getting those leaks, and we're fairly certain we know where they came from.
All right, before we get to the Custodia situation specifically, let's give our viewers more of a broader sense of just how big this problem is. I mean, we know, as I said, we mentioned Signature Bank. That was sort of kind of confirmation. We had former Congressman Barney Frank come out and say that this was sending a message, because Signature Bank serviced a lot of crypto customers, and He was saying this is sending a message to the banking industry: do not do business with crypto providers, with anyone in the market. I'm paraphrasing him. And of course, Barney Frank, known for Dodd-Frank, co-authored one of the bills to for greater oversight of the banking industry after the 2008 financial crisis. To be fair, he is on the board of Signature, but the fact that somebody like that is calling it out for what it is. We heard from the CEO of Circle yesterday here at the conference, Jeremy Allaire, saying that 5,000 crypto institutions, I believe, have been debanked. So give us a sense of the size and scope of this problem.
It's pretty much industry-wide. To your point, they decided to throw the baby out with the bathwater and try to kill the industry. What's been fun about being so public and being out front is that insiders have come forward, multiple insiders. Washington, D.C. is a sieve. And just like in the Trump White House, the White House staff in the Biden administration, I'm told, I can't prove this, but I've been told now from multiple people, we're in a civil war with each other. And about 18 months ago, there was a presidential executive order that came out that was fairly positive. Back then, the pro-crypto team was winning. Then came FTX, and then the anti-crypto team won. And there were some personnel changes that happened between Thanksgiving and Christmas. And it all lines up timing-wise with the crackdown that started happening around that time and into January. And then Custodia was at the beginning of it. And some folks at the time identified, because Custodia had applied to become a Fed member bank, which means a bank directly regulated by the Fed, and was playing ball, doing everything right, asking for permission rather than forgiveness, doing everything to work with regulators. and we were the ones who were the most harshly treated. And so the observation was that it was a so-called shoot the stallion to scatter the herd approach to send the message, as Barney Frank was saying as well.
So is this a coordinated attack then?
That's what I'm told. And again, the evidence that we have from the reporters who were leaked in advance, that the applications were supposed to be withdrawn at the same time. Each application under federal law has due process rights. Our applications are to be considered individually, and clearly they were not. There was a coordinated effort to make us all run. Everyone except for Custodia withdrew their applications. We stood our ground.
How many applications were withdrawn?
At least 3 that I'm aware of. And these are bank applications. These are no small thing. People have invested millions of dollars and years of time to get these applications. And in our case, the application that we put in to the Fed in October 2020 literally said turnaround time 5 to 7 business days. And it was 27 months in at that point when we were finally denied.
So that's an unusually long period of time, safe to say, for that denial. And you are now taking legal action
Correct.
Against the Kansas Fed.
And the Federal Reserve Board of Governors, the federal agency in Washington, D.C. as well.
So to help our viewers understand, you're trying to get a master account,
Correct.
Which means what exactly?
It means a bank account for banks. Custodia is an operating bank through a partner correspondent bank. We have multiple partners. At the moment, we're a state chartered bank, but we have to clear our FedWire and ACH transactions through partner banks. And what we would like to do is have what is statutorily guaranteed to us, which is the ability for us to bank directly at the Fed itself. And that's what we applied for, and that's what we did everything we could to achieve through normal channels, and we're forced into this.
What percentage of banks qualify for this master account?
Well, every depository institution that is eligible, including Custodia, qualifies. And historically, every depository institution was granted a master account. But just like with Operation Choke Point at the FDIC, the Fed started picking and choosing winners about a few years ago. The first lawsuit against the Fed because it arose because the statute actually says the Federal Reserve shall service all eligible depository institutions. And there's an interesting history that your viewers might appreciate. It was during the Volcker Fed that particular statute was enacted in the Monetary Control Act of 1980. It was Volcker himself who begged Congress to treat all depository institutions equally. And that's why the law says what it says. And for decades, the Fed didn't challenge any eligible depository institution, but around the Obama administration is when the federal banking agencies started to grab all this power that they didn't previously have, and of course the courts are the venue for banks to enforce our legal rights.
What percentage of banks that do not service the crypto sector or do not have direct ties with the crypto sector have been denied this master account?
To my knowledge, pretty much zero.
Is there a case to be made Custodia just isn't eligible?
Oh, no.
Just to play devil's advocate here, can they say?
No,
well,
great question. A great question. There's a reference in the footnote of the Fed's public explanation for our denial of our membership application that it did deem us eligible. So even the Fed itself has deemed us eligible.
Well, I know that Custodia is not FDIC insured.
Correct.
But recently, the list of the banks with master accounts from the Fed has been published. And I believe that there are dozens and dozens and dozens of banks that have this master account that are also not FDIC insured.
Correct. 414 to be precise.
Okay, so that can't be it.
Absolutely not. Although it's interesting because if you look at the old, before it was Senator Pat Toomey that got an amendment to the NDAA, the National Defense Authorization Act, in December of 2022, requiring the Fed to open the kimono and disclose who has these accounts because they're so valuable. And when they disclosed that list, it was a shock to a lot of people that 414 uninsured institutions have accounts because previously, including in 2 prior lawsuits over this very issue that the Fed was able to block, the Fed raised the lack of insurance of the applicants as the issue. And I suspect in one case there was an agreement that I suspect that it was a credit union. That credit union may not have agreed to the settlement that it agreed to had it understood that there were 414 uninsured account holders, because back then the Fed was taking the position that essentially you have to be insured, and that they weren't going to provide an account for the uninsured credit union. Well, it turns out there are 414 uninsured accounts, and so when the real kimono was pulled back, the Fed was hiding something.
Why is Custodia not insured then?
Oh, good question. We applied, and the FDIC told us essentially 18 ways from Sunday. We went through what's called a draft application process where they'll give feedback, and they said don't bother applying. That was not a surprise because of what we just talked about with Operation Choke Point, that the FDIC was not positively inclined towards this industry to begin with. Yeah. And there was a debanking wave in 2017 for this industry. So the FDIC had really, it was pretty clear the FDIC wasn't going to play ball, but we tested it because, again, we did everything right.
Well, the FDIC and the Office of the Control of the Currency actually singled out the crypto industry in a statement released earlier this year saying it's important that risks related to the crypto asset sector that cannot be mitigated or controlled do not migrate to the banking system. The agencies are supervising banking organizations that may be exposed to risks stemming from the crypto asset sector and carefully reviewing any proposals from banking organizations to engage in activities that involve crypto assets. And then they went on to list the risks, including fraud, volatility, contagion. So they're saying they don't want these risks to migrate to the banking system.
Correct.
And then they also add their PS, banking organizations are neither prohibited nor discouraged from providing banking services to customers of any specific class or type as permitted by law or regulation.
Yeah, right.
It's like that little fine print, like on those pharmaceutical commercials where they kind of list the symptoms may include blah, 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 blah.
Well, they don't want to be sued again,
right, exactly.
And they don't want to be accused of breaking the settlement in the original Operation Choke Point lawsuit.
So they did say that, but at the same time, they're literally saying important that risks related to the crypto asset sector not migrate to the banking system. So they're pretty upfront about this.
They are. But by the way, I don't disagree with them. And I've said this before. Crypto settles in minutes with irreversibility. And in the United States, the vast majority of the quantity of banks, remember there are 4,236 banks in the United States, the vast majority of which are quite small. They don't have the technology to deal with assets that settle that fast. Most of those banks are still only updating their books and records once a day. Okay, so if assets are settling in minutes, you quickly can realize there could be a bank run at a bank that only settles its books and records once a day, but they're dealing in an asset that moves within minutes and is volatile in price, even if they're just banking those customers. So I didn't push. We chose not to fight the FDIC on this insurance question. But here's also something interesting that your viewers will appreciate. The concept of a non-lending 100% reserve bank. That's what Custodia is. We're a non-lending bank. When you have liabilities that can move at the speed of light, essentially, right? We saw that in Silicon Valley Bank. Literally, no one in the banking industry, not no one, but most folks, did not think that a bank run could happen in the span of a few hours. Now we know it can.
Yeah, these
all
days,
right.
sure.
What do you think the stability of a business model that is making long-term loans with deposits that can be withdrawn in the span of hours? It's fundamentally unstable. And so the solution is not to keep the industry from banking access. The solution is to have non-lending banks that keep 100% of customer demand deposits in cash. And that was exactly what Custodia proposed. It's the old non-fractional reserve lending bank that I'm sure a lot of your customers are familiar with, the Rothbardian Bank. And that's exactly what Custodia is. And that absolutely can solve the risks that the FDIC is concerned about.
So let's get to the why, okay? Why is there this big push against the crypto sector, do you think?
Well, what we've been told is that based on who is behind it at the Biden White House, that it really is a throw the baby out with the bathwater, and that these folks believed that the entire industry was just built on sand, and that by tipping it over and making it very difficult to move back and forth between the traditional US dollar system and the digital asset system, that the leverage bubble would burst and it would all go to zero.
Or is it because it's a big threat to traditional finance and a big threat potentially to fiat currency and central banks? And they're very invested incumbents that do not want to see this progress because it threatens the establishment.
Yeah, well,
or there's that.
There's that, and there's an interesting question about the intersection of those two things as well. The concept of regulatory capture, the concept of you have to do it our way or the highway, and anyone who does it differently is trying to put a square peg through a round hole. But here's the problem. In the United States, the law is very clear that the states, in the case of state chartered banks, can choose which types of banks to charter. And there are now 6 different states that have chartered non-lending 100% reserve banks. And it's so interesting because it's not political. 3 of those states are red states, and 3 of those states are blue states, proverbially. So this doesn't cut across Republican and Democratic lines. It does cut across 10th Amendment versus centralization of power in the federal government, for those who are interested in that federalism concept. But the Federal Reserve, when the U.S. banking system was set up, if we go back to the founding of the United States, only states chartered banks. And then during the U.S. Civil War, the National Bank Act was passed, and there was a federal chartering authority, the OCC, that you mentioned before, and they had equal chartering power to states. And then roll forward, the Federal Reserve gets created in 1913, and then the FDIC in 1933. Those 2 entities, the Federal Reserve, which operates the payment system, and the FDIC, which is the insurance company for the banking sector, those 2 entities were designed to be utilities. And the way that Congress created chartering authority was it prevents those 2 entities from chartering. They are supposed to service the industry and supposed to defer to the chartering decisions of the states. And as we just talked about, under the Obama administration is when that crack started to appear, and the federal utilities, namely the Federal Reserve, which operates the payment system, and the FDIC, which operates the insurance company, decided to pick and choose who they were serving. That is not legal, and it is being tested in court.
Okay, well, we know that there are certain members of Congress that are very, very unfriendly towards crypto, leading the anti-crypto army, none other than Senator Elizabeth Warren.
Correct.
But when you say this is coming from within the White House, you don't mean Congress necessarily, you don't mean senators necessarily, you mean the White House as in the inner workings of the Biden administration.
This is what we've been told. I admit I can't prove this. This is one of those inside baseball things, but when I talk to folks in Washington, it is an open secret. What I've been told is that there were these 2 factions, and the anti-crypto faction was the domestic policy team inside the Biden White House, and the pro-crypto faction was the national security team. The national security team has always been, actually, believe it or not, even in the Trump White House, the national security team was more favorable. Why? Because crypto is pseudonymous and can be traced. And so they're much more interested in having criminals and terrorists use blockchains because at least there's some traceability, whereas using good old-fashioned $100 bills, there's a lot less. But the domestic policy folks, if you look at their background, they are tied to Senator Elizabeth Warren. And what I've been told, and it's so interesting, every time I appear on a podcast, seemingly, someone else comes forward to fill in more blanks, because there is literally a civil war.
Have you been told specific people within the administration?
I won't name names because I can't prove them.
Okay.
But they're open secrets. That Ryan Massari, who's the sponsor of this, Ryan Selkis of Massari, is a sponsor of this conference, has tweeted out the name of the person. And I've never met this person. I have no idea how we ended up on his radar screen, other than he was empowered. And I've been told that he stepped into a power vacuum again around that Thanksgiving, Christmas, January timeframe. If you look at what happened, the White House Chief of Staff role was transitioning, and the National Economic Council head was transitioning, and some of the foreign policy team, the national security team, were also leaving. So there was a big turnover in the White House, and what I've been told, again, can't prove it, but it's an open secret in Washington, is that that anti-crypto army in the domestic policy team moved into the power vacuum and took their opportunity to start this all-of-government crypto crackdown across the entire U.S. government.
And you're saying that this directive is now filtering through to various agencies, right?
That seems pretty clear,
Yeah.
because the agencies, they're now admitting they're coordinating, they're putting out joint statements. And like I said in the very beginning, it was a little bewildering because we didn't know why we were targeted and why we were first, but we did know there was coordination among the banking agencies because the press to whom it was leaked was telling us this in email.
Yeah. So, Caitlin, I mean, it begs the question, who is really behind the directive, in the sense that usually with politics, there's a money agenda. There's a lobbying agenda that is causing these sort of actions to take place, that's pushing for certain policies to be filtered through. Who's the money behind this? Follow the money, right? Who do you think are the parties that are pushing to have this filter through the agencies, through Congress?
You know, it's so interesting because I don't know that this one is money. At least the people who are allegedly behind it don't seem to, they are as outspoken against the big banks as the rest of us, and concentration of corporate power. If you watch what they're actually doing, though, what's happening right now, the big banks are getting bigger. The smaller banks are getting crushed by regulatory requirements.
They always say, watch what they do, not what they say. So
correct. Are they really protecting the incumbents? I think that's maybe where your question is going. I can't prove that.
Is this directive, again, purely speculation here, but is this directive being sponsored by some of the biggest players in the traditional banking system, do you think?
I don't know, but I asked that question of the insiders because I'm very curious what's really going on here. And again, the fact that there were pro and anti factions in both the Trump and Biden White Houses, I find interesting. This does not cut across traditional political lines. Yeah. And one pointed out to me, what is the motto of the White House? Build back better. What does that imply? Tear down so we can build back better. And that was how this person explained it to me. I don't know if it's true or not, but and then we had the other conversation, which is a lot of this is ending up in the courts. We've seen multiple lawsuits now against the SEC, and then of course multiple lawsuits against the Fed for Fed master accounts, not just involving the crypto industry. And these lawsuits, very interestingly, are what I call bet the farm lawsuits, in the sense that the agencies are opening long-term questions about the extent of their jurisdiction. And these are now in the federal court's hands. And this collective crypto freakout of the Biden administration, Biden White House specifically, I guess they're okay with that. And that was my question to some of the insiders. Why? What on earth are they taking the risk of potentially having the federal agencies have their jurisdiction wings clipped by the court system? And one of them explained it as that they thought if they lose in the courts, it's just going to give them an excuse to pack the courts. Again, I can't verify any of this. I'm certainly no insider, but I'm asking a lot of questions and getting essentially the same answers back when I'm talking to folks in Washington, including some of the insiders. And I'm so grateful. If there are any insiders listening to this and you can fill in more pieces, please contact me. I will protect the names of the folks that I won't disclose them in the press. Right. But it's all making sense that but again, I don't think the same way that the folks behind this do. I'm not sure that it's necessarily the JP Morgans or the Citis or the Wells Fargo that are pushing this. I think it may very well be more that there are real ideologues pushing this in a very, very hard way.
Yeah, well, it's interesting because, as you point out, we have these federal regulatory bodies overreaching their powers and now potentially having them curbed through these lawsuits. So where do things stand with your current legal case? What's the status there?
So it's public information that we survived the motion to dismiss. That came out in June, and we are now in what's called the discovery process. And that discovery process ends mid-December. And a trial date has been set for April 2024 if there's going to be a trial.
Okay. April
2024.
What else happens in around April 2024? I believe that's the halving cycle that we're expecting,
Yeah.
which is a very good segue to my next question, because you have pointed out that you think that Satoshi Nakamoto actually timed the Bitcoin halving cycles to coincide with election years. Expand on that.
Well, Satoshi created the halvings every 210,000 blocks, which is approximately every 4 years at 10 minutes a block. And Satoshi created Bitcoin in 2008, right at the peak of the collapse of the US financial system in the great financial crisis. And what was happening right then? A presidential election. So no one, of course, can say definitively that Satoshi timed it to coincide with presidential elections specifically, but every 2010 blocks, starting in October 2008, works out that we get into roaring bull markets typically right around the time of US presidential elections, which is about 6 months after each of the halvenings every 4 years.
Well, everyone, thanks for watching another edition of Token Topics. What did you think about what Caitlin Long stated? What do you think about the war going on behind the scenes over the regulation and who's going to control this financial system? If you do enjoy the content, please do consider subscribing so you can stay up to date. And thanks again.